CoachTTackleTrading.com, and had a question from Fernando in this edition of our Coach's Mailbag. Fernando posted in our clubhouse over on Tackle Trading. We have a community forum we call the Clubhouse. And he says, okay, my so far so good 45-48 bear call on AA today. It's getting a rough day. Wondering best way to hedge this. Perhaps selling the 48 calls, adding puts. IV is good, juicy enough. And the chart, as you're looking at this, by the way, you'll notice that Alcoa was in a downtrend. Lower pivot high, lower pivot low. Weak performance on earnings. Lower pivot high, lower low. Equal high moving into a range. Bear pivot starting to sell off, even starting to break down here. Good identification, good read on the chart, Fernando. The gap up here put you into resistance, and obviously that's where the concern is. Now, your strike prices were for the 45-48. I'm guessing probably October is what I'm guessing, but let's kind of walk through that just a little bit. Here's the chart. There's a few considerations here. Number one, you have earnings in 2 weeks anyway, so you have to do some management about that. Usually credit spreads are not the best strategies to hold through earnings without a plan. It's probably not what your plan was, but just wanted to make a note of that. The stock, from when you posted that to even when I'm looking at it, it has improved a little bit. But the same basic problem is there. You know, you had a gap up that is now selling off. And I got to double check. 45-48 bear call spread. So if I go to a risk profile on Alcoa and I simulate the October 45-48 bear call spread, here's your risk profile. Now, my guess is, Fernando, you probably have done this, in the past with a couple, obviously bear calls and credit spreads and whatnot. A very common rule is to get out if it ever goes in the money. There's a couple of key locations that are important. You'll notice where the pink line and the blue line switch over. That's what they call a theta switch. Your credit spread, if it's up here, is a cash flow trade. You actually go into negative theta if you move too high on the chart. So at 46.36 or so, you'd have your theta switch. Your strike price plus your break-even point somewhere in the 45s, I'm guessing, but that's the at expiration break-even. The best thing you can do when a credit spread has gone wrong is just get rid of it. Okay? Just take the hit. Don't move on. Don't try to fix every trade. Now, that being said, the second best thing you can do is manage it with a rule that is based on how you've designed it in your system. And that could be an adjustment. If you add a few different things to this, okay, the first thing I would consider is adding the 48 strike. See, if you add an extra contract to the 48, which is your long strike, now you have a long option call ratio back spread. You still have, some degree of protection if it goes back down. It does change the nature of the trade. That's called a call ratioed spread. The next thing that you could do is just buy back your 45 short. Now, if you buy back the 45 short, you're going to have an option risk graph that is like a long call option. It would have to go all the way back up above like 48, 49.50 to make any money. I don't know. That'd be a tough call. You're leaving yourself, if you buy back the short 45, you're leaving yourself with only the long 48, which means it has to be very bullish and aggressive. By the way, it has to be pretty bullish and aggressive even on the call ratio if you did either of them. If you have more than one contract, say like 10 contracts, you could hedge the delta rate. So like negative 260, I should say, on the bear call spread. If you bought 300 shares of stock, it's going to turn into a very ski-wampus looking graph. But then you're going to have some, let me forward day step this thing. You'll have some characteristics that are interesting. Number one, you'll have like positive theta as we zoom in on the graph. You'll have positive theta in here. And by the way, you don't have to do this on 10. Even if I go back down to 1, then you would just need like 30 shares, okay? 30 shares of stock. The cost on 30 shares alone, $1,000 on margin, probably, you know, so not a big deal. The vertical credit, you do then keep positive theta between 41 and 46.5, and you do protect yourself if it goes all the way up as well with the long shares. That's called a delta hedge, and on your current price, you don't even need 30. 30 would be over hedging. You have 11 delta. If I do 11, see, the more shares that we do, let me just give you a couple of different windows. 5 shares doesn't hedge you too much, okay? Keeps a profit window here, not a lot of protection. 10 shares, we've hedged off much of our delta. 20 shares, we hedge off our entire delta. It changes the nature of it a little bit, changes your reward and risk behaviors. 30 shares opens it up a little bit more to the upside. Now you actually lose if it goes down as a bear call. So you're changing the risk graph. So the simplest way to not affect the math, by the way, is to use the stock to hedge. If all you're trying to do is change the delta because the chart has changed, because if you add options to hedge, you're changing the gamma, the theta, and the vega as well. In fact, you move into a negative theta position whenever you hedge by adding options. Again, going back to my original answer, the simplest thing to do when you're losing on a trade and it's time to get out is just get out, have nothing, and move on to a new trade. Simpler design. But if you do want to learn to hedge and adjust and do beta weighting and whatnot, there are some advanced tools that can be used every now and then that are very, very effective. Number one, buy an extra long option, change the risk graph, or hedge with the stock to change the delta. It's been a video from tackletrading.com. Get in our clubhouse, get in the game, get out there, do some good. See you guys.